Good afternoon, ladies and gentlemen. We're going to get started. We're glad you could join us for the latest installment of the Option Industry Council's webinar series. My name is Alexander, and I'll be guiding you through today's session, Why Use Exchange-Listed Options. I'm pleased to welcome our presenter today, Mark Benzaquen, who is an integral instructor for OIC, providing investors with the core teachings essential for options investing. Mark is a Senior Investor Services Specialist for the OCC. He's responsible for providing support to a comprehensive options resource center that provides information and education about options and supports all products traded on all OCC participant exchanges. Mark began his career in options with Stafford Trading before transitioning to brokerage operations, but Mark spent most of his career in the trading pit.
Hi, Alex, and thank you for that introduction. And ladies and gentlemen, thank you for joining us today. And it's a great question. Why use options? I guess another way to look at it is why not? Why shouldn't we use exchange-listed options? And more importantly, why aren't we using options in our portfolio? The OIC did a study not too long ago and found that about 25%, but between 25 and 30% of the financial advisors were recommending the use of options with their clients. And the big reason as to why that other 70 to 75% weren't recommending options was simply that they just didn't know about them. They thought they were too risky. They thought they were too expensive. But more importantly, they didn't know enough about options, the risks and the benefits of them specifically, to recommend them to their clients. So that's something that we're going to get into today, why we use options, the benefits and risks of trading exchange-listed options in your portfolio. And before we get started, obviously, we've got to look at a few disclaimers here. First and foremost, options involve risks and are not suitable for everyone. As a matter of fact, before you can begin trading options, before you even open that options trading account, your broker is going to require that you read and understand the options disclosure document, the characteristics and risks of standardized options. For a free complimentary copy, you can contact your broker or the OIC. Also, to keep things simple today, and really that's what we want to do. We want to keep things simple. These are going to be complex concepts that we're talking about. And options aren't easy. So in order to keep things as easy as we can, we're not going to be speaking specifically of things like commissions and fees and other costs that are associated and that will impact your trading account. And also all of the things that we're talking about today, the strategies and the ideas, the concepts, they are simply for educational and illustrative purposes only. Now, speaking of educational, that's where we come in, the Options Industry Council. We are a not-for-profit organization. We provide free and unbiased professional options education, and we mainly do that through our website, optionseducation.org. We've got a variety of online courses and podcasts, videos. On our website, we do these bi-monthly webinars, and again, thank you for joining us today for ours. And then most importantly, at least for me personally, is our investor services desk, where a team of options professionals are ready to answer all of your options-related questions. Now, one of the slides that our director is most proud of is this annual options volume. You can see for since the inception of the exchanges, the option exchanges back in the early 70s through the late 90s, that options volume has remained fairly stagnant, but increasing, but certainly nothing to write home about. And then in the late 90s, early 2000s, you see that it just explodes exponentially. And that's something that we're really proud of, because we feel that our education has hopefully led investors to know more about options, become less afraid of them, and be more willing to trade. And all of that trading happens on a handful of exchanges now. There's 15 different exchanges owned by 5 main companies. There you see the CBOE and the NASDAQ, the BOX, which is the Boston Exchange, MIAX in Miami, and the NYSE. And all of those 5 exchanges own a number of different exchanges as well. Speaking of which, let's jump right into it. We're going to start out, for those of you that are new to options, and it looks like there's quite a few of you, we're going to start out with a very basic introduction. Now, this introduction is going to be a very brief overview. We're not going to get into the weeds, as they say, and really dissect the ins and outs of beginning options. What we're going to do is just a high-level overview of what calls are, what puts are, what it means to buy and sell options, etc. Before we get into the 4 reasons that we're going to be talking about today, namely risk mitigation, income generation, purchasing stock, and leverage. Risk mitigation, we're going to be talking about protected puts, one of my favorite option strategies. For income generation, we're going to be looking at the covered call, and then I had mentioned buy the dip. That's where we purchase stock at a discount. And then lastly, leverage, getting the most out of your money. And luckily, we were able to design this presentation to where it shouldn't take too much of your time, and it leaves us plenty of time at the end for some final thoughts and, most importantly, for some Q&A. I know that one of the things that our attendees absolutely love is asking questions about options, and we're certainly very happy to answer those. So we'll be taking Q&A at the end of the presentation. So that being said, let's go ahead and get into what is an option. Well, simply put, an option is a contract, and that contract gives, like all other contracts, give buyers rights, and it gives sellers obligations. In the case of option contracts, the buyer has the right to buy or sell an underlying asset at a specific price within a specific period of time, while the seller now has the obligation to buy or sell that asset. And the asset that we typically talk about is stock, 100 shares of stock or 100 shares of an ETF. Again, buying or selling the underlying asset at a specific price within a specific period of time. And the main topic here, or the main point that I want you to take away, especially for those of you that are new to options trading, is simply this: buyers have rights and sellers have obligations. Buyers are in the driver's seat. Buyers make the decision as to what they want to do with that option. Sellers have the obligation to accept that choice that the buyer makes. So buyers have rights, sellers have obligations. Now, why would we use options? Simply put, and we talked about this a little bit earlier when we did our outline, is that options give us more ways to implement our market research. Without options, we could do one of 2 things when it comes to investing. We can buy stock and hope it goes up, or we can sell stock short and hope it goes down. But that's really about it. Those are our only 2 choices. If the stock doesn't go anywhere, well, we don't make any money. If we buy stock and the stock goes down, well, we lose money and we don't have any protection should that stock go down to zero. And, it does happen from time to time. There were some very big companies not too long ago, certainly back in the 90s, that people thought would be around forever, that eventually went to zero, went bankrupt, and some of those household names for decades are no longer around. So it does happen that stocks do go to zero. So options we can employ to give us protection should that happen. They allow us to reduce that risk that we were talking about. If the stock doesn't move anywhere, if we buy shares and the stock's not moving, we're not making any money. Well, with options, that can happen, and we still make money. We can generate income. Again, we talked about buying the dip. We can use it for stock acquisition. We can get shares below the current market price, buy them at a discount. We can use it for leverage. There's a number of reasons why we use options, but when it comes down to it, this is it. Options offer us flexibility. We're not locked into buying shares or selling shares. We have a number of choices. As a matter of fact, if you go to our optionseducation.org website, we have a strategies page that lists almost 4 dozen different popular option strategies, 4 different ways that we can use to reduce risk or generate income or use as leverage, what have you. So options offer us flexibility. Now, here is a chart that is probably one of our most important slides, especially for the beginners. Calls and puts are the 2 different types of options that we have, and if we are a buyer of the call, It is being known as going long the contract. We are the buyer, we're the holder of the option, and it gives us the right to buy 100 shares of the stock at the strike price anytime before expiration. All right, let me repeat that. If we buy a call, we have the right to purchase 100 shares at the strike price anytime before expiration. If we buy a put, we have the right to sell 100 shares of stock anytime before expiration. You know, when it comes down to it, as complex as options are, there's only 4 choices is what it really all boils down to. We can buy a call, or we can buy a put, we can sell a call, or we can sell a put, and that's it. Now we can combine those 4 individual, what we call legs, we can combine those 4 individual legs into various strategies, into complex trades. For those of you that are familiar with options, we can combine them into spreads with 2 or more contracts. But when it really comes down to it, it's just these 4 individual concepts. Buying a call gives us the right to buy stock. Buying a put gives us the right to sell stock. And then conversely, selling the call, now we accept the obligation to sell those shares. And when we sell a put, we are accepting the obligation to buy those shares. Now, for that obligation that we accept, we're not doing it for free. Option sellers receive what we call a premium, right? There's a price. When you buy a contract, there is a price that buyers pay and that sellers receive. That price, that options premium, is what we pay to have that right. If we're buying a call, to have the right to buy that stock, well, we're going to pay for that right. And we're paying that for that right to the seller. The seller accepts the obligation to sell those shares, and in return, they receive that premium. So that's really all we're going to cover with the basics, those 4 items there: buying calls, buying puts, selling calls, and selling puts. We can definitely get into it in much more detail on our website, which is currently undergoing a redesign, by the way. It should be unveiled within the next 2 weeks. I believe the end of July, we're going to have a brand new redesigned website, so definitely keep an eye out for that. And all of the materials that we have, especially the basic materials about buying calls and puts and selling calls and puts on the website. So definitely take a look for that information. Now, when we get into the reasons that we use options, which is really what we're talking about today, this is one of my favorites, risk mitigation. And this is one of my favorite quotes when it comes to finance, when it comes to options specifically. When you can remove risk, do it. When you can't, reduce it. Okay, option traders, one of the things that I learned on the trading floor, I was on the trading floor for more than 20 years, and very rarely did these professional traders, the professional market makers, very rarely did they have any risk in their position, meaning when they would do a trade, they would almost automatically do some offsetting trade to reduce that risk. For those of you that are familiar with options, if they were to buy a call, they are now long the contract, they're long deltas, right? And they would automatically offset those long deltas with selling stock, maybe selling another call against it, doing some other trade to minimize their risk. And for the professional traders, that's what they're all about, minimizing that risk. So that's some of the reasons that we're going to be using options here. One of the reasons that people don't use options, I should say, is that they feel it's too risky. It's something that we hear a lot about, and that's probably myth number 1 when it comes to option trading, is that options are too risky. Of course I don't trade options. They're way too risky. You can lose your shirt. Well, yes, they certainly can be risky if you don't know what you're doing. But on the flip side, they can also specifically be used to reduce risk. And that's what we're going to look at here with the protective put. A protective put is when we own shares of stock and we also buy a put. Remember, when we buy that put, that gives us the right to sell shares at the strike price within a specific period of time. So with a protective put, we own the shares of stock, and we have the right to sell those shares at some specific price within a specific period of time. And you can look at it this way. It's an insurance policy. On our portfolio, on a specific stock, what have you. We may buy a protective put if we're bullish and we're looking for protection against a downside move, because we have the right to sell those shares at a certain price. Now, when we look at the protective put, as I mentioned, I liken it to an insurance policy. For example, we own an asset, like our car, for example. We've got insurance on our car that should an accident happen, we don't want the accident to happen, right? But should the accident occur, we're going to be protected. We're not going to lose the value of our car. That insurance is going to kick in. The insurance agent is going to pay us the value of our insurance policy minus whatever our deductible is, and we're going to get some of that money back. Well, that's the exact same thing how this protective put works, is that if the stock happens to implode, we're able to sell it at the strike price and get that money back, or get a good chunk of that money back. Because again, that protective put, it provides us that downside protection. We can go ahead and sell it. We can exit that position at the strike price because we have the right to do so, because we're an option buyer. Remember, option buyers have rights. And the great thing about the protective put, and again, look at it like your car, if you don't get in an accident, you buy a 6-month insurance policy, for example, if you don't get in an accident in that 6 months, well, wonderful, you didn't use the insurance, but and it doesn't matter because you don't want to get into the accident. Kind of the same thing with the protective put here. We're bullish on the stock. We want it to go up, but just in case it doesn't, we've got this protective put. If it does go up, right, well, we continue to participate in that profit, in that appreciation of the share price. We go ahead and participate in that, which is what we want to do to begin with. What we're looking to do, however, is limiting that loss should the bad news really happen. Now, the loss is limited to 100% of the premium paid, meaning that the price of the put we can lose. If that insurance policy expires and we don't get in a car accident, well, the premium that we paid for that policy, we lose. Nothing happens to it. We don't get the money back. Same thing here with the protected put. We would lose the money that we paid for the put, and we would not get that money back. But however, that's not really the goal. The goal is to protect us against some bad news with the stock. Another thing that I like about the put, and this is something that we're going to look at in the next example here, is it can allow us to lock in our profits. And let's go ahead and take a look at how it allows us to do that. So here's an example. We've got stock trading $65. Again, we're bullish on the stock, and but here we own it from $60. So we already have a built-in profit, but we're looking to either lock in some of that profit or limit our downside risk. Let's say there is earnings, for example, coming out, or there's a drug trial, and let's say if the news is good, if the company passes the drug trial and the drug works, the stock is going to skyrocket. If the news is bad, well, there you go. The company may not exist in a week. So we're worried about that. So we're going to go ahead and buy a put to protect our position. So should that drug trial go south on us, we have the right to go ahead and sell this stock at $65. So what we're going to do is we're going to buy that put. We're going to buy us 2 months worth of protection, because that's when the news is going to be coming out about this drug trial sometime over the next 60 days. We're going to buy a 65 strike put, and it's costing us $2. Now, when we say $2, in the real world, an option contract represents 100 shares of stock, so that is $200 of our investment. So we own the stock from 60. It's currently trading 65. We buy a 65 strike put, which gives us the right to sell those shares at $65. Now, why wouldn't we just go ahead and sell the stock outright as it is? If we're worried about it going down, why don't we just sell the stock right now? Well, we certainly could. We can sell our stock at 65. We lock in $5 worth of profit, or $500. But what happens if the drug trial is a success? Now that stock goes from 65 to 100. if we sold those shares, we're not going to be able to participate. And remember, we're bullish on the stock. We're just looking for some downside protection. So we buy the put instead, so if it does appreciate in value, we're going to go ahead and be able to participate in that. So let's take a look at how that's going to appear, and here's our table. For those of you that are numbers oriented, right now stock is trading 65, and if it stays at $65 between now and expiration, and that's where it expires, we're going to make a theoretical $5 profit on those shares. We bought them at 60. They're now worth 65. Our option expires worthless. Remember, we didn't get into the car accident that we were looking for protection from, and that's okay. We paid $2 for the put, and that's what we're going to lose. We're going to lose that $2. So we theoretically made $5 on the stock. We lost $2, which is the price of the put that we bought. That gives us a net profit of $3. Now, again, the reason we didn't sell those shares is because we thought the stock was going to go up in value. And let's say it goes up to 70. Those shares are now worth an extra $10 based on where we bought it, minus the $2 that we paid for the put. Again, we didn't get into the car accident. We have an $8 profit. We're participating as the stock appreciates in value. That's what we want. Conversely, on the downside, the drug trial doesn't work, and the company, the shares of stock plummets down to $50. Well, now we lost $10 on the stock. The good news is we bought that put. So we sold those shares at $65. That put is now worth $15. We lost 10 on the stock. We made 15 on the put. That cost us $2 to begin with. That gives us a net profit of $3. No matter where that stock goes, south of $65, we're going to lock in $3 worth of profit. And for those of you that are visual, here's what our graph looks like. Here's our long stock, $60. Look at that. There's our profit and loss. We have no break even because we will always make money. We have no maximum loss. There is no loss. We have a minimum profit of $3. With this particular strategy under these conditions, we have a minimum profit of $300 per option contract. Maximum profit is unlimited. We we make money as the stock makes money. So that's one of my favorites there, the protected put, simply because it dispels that myth that options are risky. In the sense of this particular strategy was created specifically to mitigate risk, not create it. So it offsets risk rather than adds it to our position. So it's absolutely one of my favorite things. Now, is the polling question that we asked earlier, the reason why everybody trades options, or why those of you, I should say, trade options, the overwhelming majority of you said income. So let's go ahead and take a look at undoubtedly one of the most popular income generating strategies, and that is called the covered call. Now, with a covered call, it's where we're going to do two things. Number one, we're going to sell a call contract, and we're either going to buy 100 shares of stock, or we already have the stock in our portfolio. If you remember from that little 4-square table, when we sell a call, we are accepting the obligation to sell shares. In this case, we already own those shares that we may have to sell in the future, so we are considered covered in our risk. So again, we're selling a one call contract for every 100 shares of stock that we have, and the reason we're doing it is to increase our returns. That premium that we receive, remember, when we sell an option, the buyer is going to pay us a premium. That premium is going to be considered income. It's going to help us generate additional income over what we have already with the stock. And our forecast on this, every time that we trade, and this is something that I definitely want to stress. Every time that you trade, you need to have two things. You need to have a motivation. Why are we doing it? Again, are we looking to mitigate risk, generate income, what have you? Why are we doing the trade? And what is our outlook? What do we think is going to happen? Where's the stock going to go, up or down, or stay the same? And in what time frame? So our forecast with the covered call is that we're neutral to moderately bullish, meaning we don't think the stock is going to move very much. It's going to trade within a small price range over the lifetime of the strategy, over the lifetime of the option contract, but we also think that it's maybe going to go up a little bit. And the reason we want it to go up a little bit is because we are long that stock. We want the shares to increase in value. But again, because we're option sellers, we have obligations. Our obligations are to sell those shares at the strike price if assigned. Now, assignment, what that means is that's our potential obligation. When we enter into an option contract, if I'm a seller, I am giving myself, or I am accepting the obligation to sell those shares. If the buyer of the contract decides to exercise his or her rights, that exercise will then be assigned to me. So that's some terminology that you may want to look up if you're not familiar with. Buyers exercise their rights. Sellers accept assignment of those exercised rights. So when we sell covered calls, we do have that obligation of assignment, which would be enable us, or I should say entail us selling those shares at any time before expiration. And in return for that obligation, we are going to collect that premium. A couple more things about the covered call. Our profit is going to be limited. Remember, we're long the stock. We bought shares of stock. If we get assigned, if we have to sell those shares, there's only so much money that we can make. So our upside profit potential is limited, and we'll look at that in just a moment on our example. Our upside profit potential is limited. Our break-even point. Where do we begin to make and lose money? Well, in this particular case with the covered call, our break-even point is going to be whatever we paid for the stock minus that premium that we received when we sold the option. And then here's something to definitely keep in mind. We were looking at the protected put earlier, and the protected put gave us protection to the downside. If stock declined in value substantially, we were protected. With the covered call, that is not the case. The downside loss potential is substantial because we still own 100 shares of stock. We don't have the right to sell those shares. We have the obligation to sell those shares. So if our option is not exercised, if we are not assigned on our short contract, we keep those shares, and therefore we still have the same risk with long stock. If the stock goes to zero, we have a substantial loss on our hands. So let's look at an example of the covered call. Here we go. We've got 100 shares of stock. It's trading 52. And again, remember our motivation and our outlook. Our motivation is that we want to generate income. Our outlook is that the market is going to be neutral and moderately bullish. It may go up a little bit, but nothing substantially. And we're willing to sell shares of stock at a specific price. In this case, we're willing to sell shares at $55. That is our strike price. For that obligation, we're willing to accept the obligation to sell shares at $55. For that obligation, we're collecting $1.75. So let's see what that means number-wise. If stock goes up to 55, right now it's trading 52. So let's look at that first. Stock's trading 52. We don't make any money on the stock. We own it from 52. That's where it closes at expiration. We don't make anything on the stock. We do collect that $1.75. Remember when we sold the option to begin with, we collected $1.75 up front. We keep that premium that we collected, so stock doesn't go anywhere. We make $175. That's our net profit. The premium that we received when we sold the options, that's ours to keep no matter what happens. Stock goes up to 55. Let's go up one. Stock goes to $55. Well, now we've got a $3 profit on the stock. We bought it at 52. We now have it at 55. Actually, our call would likely get assigned, so we would be forced to sell those shares at 55, but which is okay. We bought it at 52. We sell them at 55. That's a $3 profit. But because we sold the call against it, we were able to generate additional income of $1.75. So here with the covered call, our net profit is $4.75. Or $475 per option contract. If we just owned the stock by itself, we would have profited the $3, $300 on the stock versus $475 on the covered call. So you can see that covered call generates additional income. Now, if the stock keeps going, now this is where we kind of, some people look at it as an opportunity cost, for example. If stock goes to $60, let's say, the stock is now worth $8 from 52 where we bought it. However, the covered call that we sold at $1.75 is now worth substantially more. Now it's actually going to be a $3.25 loss from where the option is going to close versus where we sold it, and that means our maximum profit is going to be capped at $4.75. Now, let me try to explain that a little bit more clearly. If the stock goes above 55, those shares are going to get called away. So it doesn't matter if stock goes to 55.25 or if it goes to $100. We are obligated to sell it at 55. So no matter where the stock goes, the most we can make on those shares are going to be $3. The $52 where we bought it versus $55 where we're obligated to sell those shares. Doesn't matter where it goes above that, we sold them at 55. We also keep that $1.75 premium when we sold the option. Our maximum profit is going to be $4.75 or $475 regardless of where the stock goes. Conversely, to the downside, let's say the stock goes down to 40. Well, our option is going to expire worthless in the sense that nobody is going to want us to sell shares at 55 when it's trading $40 in the market, let's say. So we're going to lose money on our stock position. We bought it at 52. Stock's now trading 40, let's say. We lost $12 on the stock. But again, we keep that $1.75 premium when we sold the option. That reduces our loss to 10.25. So we're going to lose money all the way down to zero. Wherever the stock goes below where we bought it, we're going to lose money on this. But that loss is going to be tempered somewhat by selling the option. So the loss is a little bit minimized, but certainly still substantial. And again, for those of you that are visual, let's take a look at what we have here on our graph. We're long stock at 52. We sold the 55 call at $1.75. So we know those shares are going to get called away at $55 at best. And that gives us the maximum profit if assigned. Again, it's going to be this formula, our effective stock sale price, which is the $55 strike plus the premium that we received when we sold those shares. So that's our effective stock sale price minus the $52 where we're long the stock. That's going to give us that maximum profit of $4.75. We cannot make more than that. Our loss is, fairly unlimited here. As far as the stock goes down, we're going to lose money, but it will be, like I said, tempered somewhat from that call that we sold at $1.75. Now, something in the news that a lot of you have probably heard, or an acronym that you've probably heard, is buy the dip. That leads us to our next income generating strategy, cash secured puts. There is a online video streaming service that just came out with earnings the other day. And the earnings weren't, the forecast, I should say, or some of the numbers weren't as good as people were expecting, and the stock was down almost 15%. If an investor is bullish on that stock, they could, and they think it's going to rebound, so that 15% decline people would refer to as the dip. And the saying goes, if you like the stock at, say, 400, you've got to love it at 350. So what some people would do is they would sell a put against those shares, and it's called a cash secured put. Typically we use at the money or out of the money puts. Assignment is potentially welcome and desirable, meaning we want to buy those shares at a discount. That's the whole point of putting the strategy on it. If you remember, the reason we sold that put, or when we sold that put, we're accepting the obligation to buy shares. So we're looking to buy those shares at a discount. So if we get assigned, you now have the risk of owning that stock, and that's a key point there. You've got the risk of owning those shares. It's a good thing if the stock goes back up, right? If it dips down from where it was and it goes back to the previous levels or higher, wonderful. If it dips down and keeps falling and keeps falling and keeps falling, well, now you've got that risk of a long stock position. So just like that covered call, you're not going to have protection on the downside, and it's definitely something to keep in mind. So let's go ahead and take a look at this cash secured put in a little bit more detail. Again, motivation and outlook. Our motivation is that we want to buy shares below the current price. And our outlook, this is the important part. Stock's trading X amount of dollars. We think that due to maybe corporate earnings or something in the market, shares are going to fall. In this case, shares are going to fall about by 10% within the next 60 days before they rebound. And that's the key there. We think the stock's going to go back up. So we're thinking, you know what, we might be able to buy these shares at a discount. We can buy the shares right now for $50. Or we can do this cash secured put and possibly buy those shares cheaper. Maybe we can buy those shares for $45. So what we're going to do is we're going to sell that 2-month 45 strike put at $2, and we're going to set aside the cash to buy the shares if we need to. If we get assigned, we're going to need to pay our strike price times 100, and in return, we're going to receive 100 shares of stock. So we're going to need to have that cash on hand in order to buy those shares should we get assigned. So we've got to make sure that we've got enough cash to do so. We collected $200 up front when we sold the option. We need to set aside $4,300 more in order to buy 100 shares of those stock should we get assigned. The idea here being is we're getting the stock for $45 a share instead of the current $50. So let's see how this would work. We're going to deposit that $4,300 to cover the potential assignment. And our break-even is going to be the strike minus the premium. So here's the key. We're buying shares for the equivalent of $45, but we're getting paid $2 to do so. So in effect, we're really buying these shares for $43 a share. That's where we get that break-even from. The most we can make is $2, but that's not taking into account the long stock position. So let me just go over that again, try to make it a little bit more clear. If the shares stay high, if the shares stay at, say, $50, our option is going to expire worthless. When we sell the put, we are accepting the obligation to buy shares. Nobody's going to want us to buy shares for $45 if they're trading $50 in the market. So if the stock doesn't go down to $45, we're not going to be forced to buy those shares. We're going to collect that $200, or we're going to keep that $200 regardless. So the thing about a cash secured put is if we're right and shares go down, we get to buy that stock at a discount. If we're wrong, we still get paid. We still keep that $200 regardless of what happens. Now, the maximum profit and the maximum loss, that depends on what happens. If we buy those shares, well, our maximum profit and loss is now that of a long stock position. If the stock continues to drop in value, we continue to lose money. If the stock then reverses and goes back to its original levels and beyond, we go ahead and make money. So our profit and loss is going to be based on the stock position. Now we've got about 15 minutes left, and I know that I do want to get into some Q&A, so let's look at this last strategy, and this one is fairly simple. This is leverage, and we're simply going to be looking at it from a long call perspective. Leverage is where we want to make our money work for us. Now, we're going to do this with buying calls simply because we want to benefit from rising prices, but which we could do anyways with stock. Stock's trading $50. We think it's going to go up. We can buy 100 shares of stock, but that's going to cost us $5,000 to do so. We don't want to spend $5,000, or we may not have $5,000. So we can buy a call instead, and it allows us to get that same benefit of the rising value of the shares, but with a smaller cash outlay and a limited predefined risk. Anytime we buy an option, the most you can lose is what you put into it. Anytime you sell an option, the most you can make is what you've collected. So let me go ahead and repeat that, because those are two very, very important concepts. Anytime that you buy an option, the most that you can lose is what you put into it. You have predefined risk. Anytime that you sell an option, the most you can make is what you've collected. You have predefined reward. Again, one of the great things about options and certain strategies, predefined risk, predefined reward. When you buy stock outright, there is no predefined risk, there is no predefined reward, there is no max gain, there is no max loss necessarily. So definitely another great reason to buy options, or to trade options, I should say. So, and again, with buying calls, one of the reasons that a lot of people do it is they simply, want to buy the call, hopefully get it to appreciate in value, and then go ahead and resell it for a profit. About 72% of all option contracts never actually live to see expiration day. They get traded in and out of the market on a daily basis. You buy a call today, you may sell it 10 minutes from now for a profit, or 10 days from now, what have you. But very rarely do people keep it all throughout that expiration. And this is one of the reasons that we trade options, is for that leverage. The problem is it's a double-edged sword. And I'll show you why in just a moment here. So here's our explanation, or here's our example. Stock's trading $60 a share. We can buy 100 shares right now for $6,000. Again, our motivation and our outlook. Outlook is that we're bullish on the stock. Motivation in this case, we want limited downside risk and also leverage. So we're going to buy a 3-month 60-strike call for $3 or $300. And here's where that leverage works. If stock stays where it is, $60, we will not have made or lost any money on the shares. We would, however, have lost our entire investment, the $300 that we have when we bought the stock, when we bought the option, I should say. So when it comes to the profit and loss on the option, we lost 100% of our investment. We lost that $300, whereas we didn't lose anything on the stock. But here's where the leverage works. If stock goes up to $65, that option is now going to be worth a $200 profit. That's a 67% return on our investment. We invested $300. That option is now worth $500, or a $200 profit. We just made 67% on our money. If we bought the stock outright, we made a $500 profit from 60 to 65, so we made more money on the stock, but look at our return on investment. It's only 8%. Now, you may be one of those investors that say, well, dollars are what really matter. I made $500 on the stock versus $200 on the option, and that very well may be true. Other investors look at the return on investment. I made 67% on the option versus only 8% on the stock. Look at our risk in the stock. The stock, we're risking $6,000. The option, we're only risking $300. There's huge, huge difference. And where the leverage comes in is if we're paying $300 for that option, well, instead of buying one option, maybe we buy 2, or maybe we buy 5, or maybe we buy 10. And we get that money to work for us. We generate substantially increased revenues, increased returns by leveraging our money and buying more options in this particular case. Now, the previous slide I mentioned how it's a double-edged sword, and here's the double-edged sword. With an option contract, we can lose 100% of our investment. So let's say we bought 10 of these option contracts for a total of $3,000 versus 100 shares of stock for $6,000. The chances of that stock losing $6,000 in a short period of time, going from $6,000 to say $3,000, it's certainly not unheard of, but it's fairly remote that the stock's going to drop 50% in value in a very, very short period of time. The option, however, all the option has to do is finish out of the money, and we've lost our entire investment. We've lost all $3,000. So that's where leverage can work both ways. It can certainly help us generate greater returns, but we've got to be careful because it can also help us generate greater losses. And when we buy a call, this is what it looks like. Here's our long stock of $60. We know, for example, that we paid $3 for the option. And remember, by buying the option, the most that we can lose is what we put into it. So the most we can lose is $3. We need that break-even point to be $63 in order to make money. The reason I say that is if we bought the option, the 60 strike call, we're theoretically buying the right to purchase shares for $60, but it's paying we're paying $3 for that right. So we really need stock to be above 63 in order to make any money, and that's going to be our break-even point. In this case, it's going to be the strike price plus the premium received, and our maximum loss, again, because we're buying options, is going to be what we put into it. So we can't lose any more than we put into it. That is one of the greatest things about options, again, that defined risk and defined reward. So we've got about almost 10 minutes. I just want to wrap this up real quick with some final thoughts. Options give us options. Like I mentioned earlier, it gives us more ways to benefit from our market outlook and profit in a variety of markets, up, down, or sideways. And it helps us do a number of things, reducing risk, generate income, etc. For more information, absolutely visit our website, contact our investor services team via email. We're always happy to talk to you about options trading. My partner calls us options geeks. Well, I don't know if I if I live up to that moniker. I think I'm a little cooler than that, but certainly we love talking options. So definitely let us know if you have any questions. And then if you are just getting started, which I know there are a number of you doing so, definitely take a look at that My Path assessment on our website. That will help you gauge your current options knowledge, and it will place you in a customized options program based on online curriculum, online courses, videos, podcasts, etc. So I'm going to turn this back to Alex now, who's got some questions I'm hoping for me. And Alex, what do you got?
Thank you, Mark. We do have a few questions today, but I'd like to remind our listeners that if you have further questions about the concept we discussed today or the tools on the OIC website, or if we weren't able to get to your question you submitted, you can contact our investor services team at options@theocc.com. Additionally, today's session will be archived and will be accessible in a few hours using the same link you used to join us today. And Mark, we have a question here from earlier in this presentation. Earlier when you showed the example with the protected put, it looked like a can't lose trade. If that's the case, why doesn't everybody do this?
Yeah, that's a great question. Yes, the protected put, it looks like a can't lose trade. I love that. Well, let's go ahead and go back to the protected put. And the reason that it looks like a can't lose trade is this. The first premise of the slide is the investor is bullish on the stock and long from $60. All right, stock's trading 65. We already have a built-in profit. That is the absolute necessity, or the reason why this looks like a can't lose trade, because it's already a winner, and that's what you need in order to lock in that profit. Your trade already needs to be a winner. And that's one of the things that I love about that protective put is it allows us to lock in some of that profit regardless of what happens with the market. If it continues to increase, wonderful, we continue to make money. If it does fall out of bed, well, at least we're protected and we're able to pocket some of that profit that we initially had without losing all of our investment. So definitely a great program and a very, very funny question, but unfortunately you got to start out with a winner to keep a winner.
Awesome. Thank you, Mark. This question comes from James. Can I sell a covered call and a protected put on the same shares?
Okay, good question. Well, there is a strategy that people use. You're long the stock, you sell that covered call. Well, let's back up for a second. The protective put, remember, it gives us a floor at which we can sell those shares. But if you remember from this example, we had to pay for it. All right. There's a strategy where we take the protective put, we're long the stock, long a put, and we sell a call against it. That when we sell that call, that pays for the put. And now that strategy is called an options collar. It gives us a floor for the shares, and it also gives us a ceiling. It reduces our risk. It gives us a maximum predefined risk That's going to be that put. It also gives us a predefined reward, and that's going to be the covered call. So the strategy that you're looking at, it's called a collar. Typically that short call, that call that we sold, pays for the put. There's what they call a $0 or zero cost collar, and that's where we're basically getting that protection for free. The downside to it, or the flip side, is that we're not getting that protection for free necessarily because we're giving up the upside profit. If you remember the protective put, let me see if I can find that slide. Remember the protective put, we had unlimited reward. As the stock makes money, we make money too. By adding that covered call to it, it puts a ceiling. So that the collar gives us a floor and gives us a ceiling. It also is a very popular protection strategy. A lot of information on our website about the options collar. So, James, if you have further questions about that, definitely take a look at our website for more information.
Great. Thank you, Mark. Speaking of our website, there's a question from the audience. I've been playing around with the covered call calculator on the OIC website, but when I plug in my trade, it only shows a potential return of about 3%. That doesn't sound like very much. Is there a strategy that I can use that will earn me more percent?
Well, keep in mind, when we talk about the covered call, and I think the example that we used, let me see if I can find it. I believe it was a 60-day covered call. Here we go. Here's the example. Just give me one moment. I apologize. So here's the call that we used. We were moderately bullish on the stock. You know what, I'm sorry, we didn't define how long the call was. Covered call is generally a shorter term strategy. When you're selling options, and this might be getting a little too in the weeds or too in-depth, when you're selling options, there's this concept called theta, and theta is time decay. So the premium that we talked about, premium is made up of a number of components: stock price, strike price, implied volatility, days to expiration, etc. Well, that days to expiration is a big component because the more time there is for an event to happen, for the stock to go up or down, the larger the premium is that sellers are going to require because they're accepting more risk. It's riskier, if I'm a seller of an option, it's riskier for me to accept that obligation to sell that option for the next 6 months versus for the next 6 hours, right? And that makes sense. The more time, the more risky it would be. So the more time there is, the larger the premium is going to be. That premium is going to decrease on a daily basis because of what we call theta. The less days of expiration there are, the cheaper that option is going to be. The sweet spot where that theta begins to rapidly decline is generally 30 to 45 days out. So for that reason, when people trade covered calls, they generally go 30 to 45 days out when they sell that option. The reason I bring that up is this. The covered call calculator that the investor was using on our website, which is a wonderful tool, by the way, will show a 3% return. But is that 3% return, let's say it was for a 2-month option, right? So if he sold that option, he or she would generate 3% return over that 2-month period. Once that option expires, they can do it again. And then they can do it again and again. They can do that up to 6 times a year. Now, obviously, after each time, you're going to, again, want to go back to your motivation and your forecast. Are you still neutral on the stock or to moderately bullish? Are you still looking for income, what have you? But assuming that that's the case, you can sell that option over and over and over and over. Should you do that 6 times throughout the year, well, that 3% return now becomes an 18% return, which is a substantial difference. An 18% return, I think everyone would agree, is a pretty nice return in your portfolio. So that 3% return is kind of misleading because it's only 3% over, say, 2 months as opposed to annualized. So definitely take a look at that and keep that in mind.
Great. Thanks, Mark.
Yeah, what do we got? Alex, it looks like it's been just about an hour. How about we take one more? Do we have time for one more?
Yeah, one more question here from Larry. He says, I have a covered call on a stock that is involved in a merger. What's going to happen to my option? Should I close it out?
Larry, excellent question. One of the things that we do here at Investor Services is we take almost a record number of calls and emails from people that have adjusted contracts. There was a merger recently with AT&T and Time Warner that was probably our busiest time in recent memory, in the sense that a lot of people were saying, look, I've got options on this. What does this merger mean to me? So the one thing, well, a couple things I would say. Your question is, should I close it out? We certainly can't make that recommendation. We are not licensed advisors. We're not we don't provide advice or make recommendations. What we do, Larry, is we provide information, and we do that a couple ways, one of which is through the OCC website, where they publish informational memos detailing all these contract adjustments. So, for your option, for example, you can take a look on the OCC website and read about how the option is getting adjusted. And if you have questions, you can certainly give us a call or shoot us an email, and we'll be happy to explain that to you. Another thing that you can do, fortuitously, as they say, is that next week we have my partner Bill Ryan is doing his webinar, his presentation on contract adjustments. He did one last year that was very, very well received, very well attended, and he's updated a little bit, and so he's going to be presenting that next week. So, definitely I would suggest you tune in for his presentation on contract adjustments, mergers, splits, bankruptcies, things like that. So to answer your question, two things. Number one, check out the website for information on your specific option contract. Number two, give us a call or drop us a line at Investor Services to discuss how that's going to affect your option. And certainly number three, make sure you tune in for Bill's presentation next week. It's certainly going to be full of information. Again, ladies and gentlemen, thank you for your time. Thanks for joining us today. And Alex, certainly always a pleasure to talk to you again and present.
Absolutely. Thank you, Mark, and thank you, ladies and gentlemen.